Co-founder. Well, Ryan, you're joining us from Paris today. And, both you and I are active users of LinkedIn. And I want to draw viewers to a post that you put up a couple of days ago of the culinary type. You posted a picture of an ice cream that you were picking up from, I think it is Bouza Bashir. I think it was Ashta ice cream. Oh. And I got myself thinking, are you beginning to see higher food prices show up because of the energy shock from the region? Tell us about the cost of your Bouza Bashir.
Absolutely. Costs are rising. We've seen it on PPI. We're seeing it on CPI. We will see it on PCE. We're going back to higher and higher inflation. This will take time to resolve itself. We're not seeing higher oil prices because of what you mentioned a bit earlier. It's the reserves, and particularly China has massive reserves. However, other countries do not have that luxury. As soon as these reserves get really close to being depleted, and we should see that around mid to end of June. This is when we're going to see much higher oil prices, and all of this will translate into more and more inflation. I've been talking to you for quite a few years now, and I always said it, inflation does not come in one cycle only, it comes in multiple cycles. We're going to see something very similar to the 1970s scenario.
Yeah, and indeed, many industry leaders from the energy space are warning about that happening, right? I mean, the IEA obviously continue to repeat that this is the largest energy shock. You hear leaders, CEOs of companies, energy companies around the world warning that things are really about to start getting perhaps a lot tighter in the next month. What does that do to the what appears to be the Teflon trade that is AI right now?
Yeah. So basically, in the case when faced with inflation, what we do, us investment managers, is obviously invest as much as possible to protect against that inflation. And usually go for stock markets because they usually protect the most against inflation. We don't go to fixed income because interest rates rise up because central banks fighting inflation. Now, in the case of the tech trade, we decided to stay away again because we believe this is a bubble. It's completely overblown. The S&P 500 today, when you invest into it, you're actually investing into tech. You're not getting diversification. So that's why we're going towards geographic diversification across the world and across asset classes. As you know, we still have 25% of our portfolio in gold. We have Swiss equities, we have Brazil, a few other emerging markets, which have done very, very well without the risk of overvaluation that we're seeing in tech stocks, which I have a few question marks on the business model around AI in the US. So this is how we're positioning. Just one last point regarding gold. Yeah. If you look at gold, if you look at it year to date, over 1 year, 2 years, 3 years, and 5 years, it has beaten the S&P 500.
Okay, yeah, no, I know that you are definitely a gold bull, and we've discussed it many times. And I see from your notes that you've got about 25% of your portfolio allocated to gold. I just want to go back to something else, which I think is becoming a bit of a technical feature in the S&P as well. And you raised this in your notes. 0 day to expiration options account now for about 60% of total S&P options. To what extent do you think this may be driving some of the recent uptick that we've been seeing in the S&P?
Well, it has been creating the momentum that has been driving the S&P and the tech stocks higher and higher. Now, what's even more dangerous is that this is mainly driven by retail investors. So this is quite dangerous as well. Add to it the negative gamma of dealers. This is even an additional danger. Now, let's look, where is this coming from? Where's funding is coming from? This is coming from M2. As you look at the M2 in the US, monetary base, it's the record high. The US economy and the financial system is flushed with cash. The Federal Reserve is buying treasuries again, balance sheets rising up again. So liquidity coming to the system. Add to it the famous yen carry trade, which is still in place, and that's why I think Treasury Secretary Brent was in Tokyo to speak with the Japanese, because he does not want the Japanese to sell treasuries to defend the yen or increase interest rates, because this will break the carry trade, and these daytime options will basically no longer be, and this will break the whole tech trade that we're seeing at the moment, which is driven by retail ultimately.
Yeah. Okay, Ryan, thank you so much for coming on and giving us your prognosis on the markets here. Ryan Lamont, CEO and co-founder of Neovision Wealth Management. Now for a look at some